What's going on, everybody? It's Patrick Auger here from the Body Lock, and today we're asking, could one championship go bankrupt? So this is a very important question. We just got the 2019 financial statements from the company and does not look good. 2019, you say? Yes, that's right. All the way back in 2019. Now, normally these financial statements are normally a year to 18 months behind, but for whatever reason, one championship got an extension on this particular statement, whether that was COVID related or something else. And thus we are just now finding out this information now. Why is it still relevant if it's 2019? Well, it gives us a glimpse into what 2020 could be and gives an idea of where the company's been trending compared to previous financial statements. So John Nash over at Bloody Elbow has a great article detailing the more, specifics of this and has covered 2017, 2018. But these financial statements now are showing that in 2019, one championship lost roughly $97 million US. That's with a conversion rate of $1 US to 0.74 Singaporean dollars. That's a lot. That's after-tax loss of nearly $100 million. Now, to give you an idea of what 2018 was like, that was the equivalent of around, using that same exchange rate, around 59, 60 million US dollars. So their loss has grown, not doubled, but nearly doubled, right? I mean, that's huge, by 66%, 67% or so. So question becomes, a company that's been consistently operating at a financial loss, their accumulated losses now equaling about $228 million. So they're not profitable. They've lost $228 million after taxes, everything all said and done. Could they go bankrupt? Well, let's look at a couple factors here. So one, looking at their financial ratios, which are key to, measuring how they're doing in terms of their peers in the industry, or, just healthy financial ratios that analysts can look at to gauge a company's profitability and health. The return on equity, which is a big one in terms of gauging how well you're doing with your peers, is atrocious. It's actually dropped over 100% to negative 58.29%, I believe it's something like that. That's insane. That's really bad. You can almost guarantee that UFC is going to have a positive ROE. Bellator will probably have a positive ROE. It might be a little small, might be on the negative side, lower, but I mean, negative 158% for your ROE means you're not doing well compared to your competitors. You're just not. So with that in mind, we look to the current ratio. This is important when it comes to bankruptcy. So current ratio essentially looks at whether or not you as a company can pay your debts that are due within a year or so. So if I have a credit card, right, I got to pay that every month. Well, imagine I've got bills where here's my year of bills. Can my company pay that? Right now, one championship is sitting at 5.9. I think 5.93 for their current ratio. That's very good. That means that they can pay their current 1 year debts almost 6 times over. The concerning part here is that in 2018, they were 19.53. So that's a huge drop off on what they would be able to pay. Their assets have also dropped more than half, down to around 98 million Singaporean dollars from 199 million Singaporean dollars. Their liabilities have gone up 5.6 million Singaporean dollars. So it's never great to, have the assets drop that much, have your liabilities go up, and have your current ratio drop that much. Again, 5.93 or 6, if you want to round up, is still very good in terms of the short-term debt. But one championship has never really been financed by debt. Unlike the UFC, where they're taking out these massive loans and doing all that, one championship relies on investors. Sequoia Capital is a big investor of theirs. You've got a couple other smaller fish here. You've got rumored investors of certain groups that pay money into one championship similar to a startup would. One championship last year announced that they got $70 million in investor funds rather, through series funding, but they still had to cut 20% of their workforce. So they're still getting money from investors, but relying that much on investors is always risky, because at any moment, the investor could say, you know what, this is a lost cause. This is a sunk cost. I've already given you a bunch of money. I'm not seeing the returns I want. I'm not putting any more in. And if they can't get more money from the investors, then they have to go to some type of debt instrument, whether that's a bank for a giant loan or something of that nature, similar to what the UFC did. in terms of going to a bank and saying, hey, I'd like to take out a huge loan to cover my operating expenses. Don't worry, we'll get profitable someday. But, I only have $228 million in, in losses. And I also, have not ever been profitable. I've been operating at a loss for a long, long time now, pretty much since inception. So it really comes down to the investors. Again, that being said, they've got a runway here, right? That current ratio means they can pay their 1-year debts for, at least a year 6 times over. So unless that ratio turns negative, or turns really not even negative, less than 1, when it's less than 1, that means you might be in trouble, depending on what kind of money you've got coming in. Then if that happens, then you're squeezed. And I don't believe One Championship has the financial resources right now where if they're less than 1, that's a really bad sign for them. That could spell bankruptcy. Based on their 2019 financial statements, looks like they're okay, at least for right now. They're going to have to keep getting investment. They're going to have to keep pitching themselves around like a startup. You've seen Chatri Sityodong, CEO, be on several shows, saying they're going to be profitable within 12 months. But he said that before, where he really believes they're going to turn profitable at a certain time frame. He misses that. So it's kind of hard to say. It's all about what the investors' appetite for risk is, right? If you really believe One Championship is going to take off, is going to end up being this big thing, if you believe the numbers they tout, if you watch them and say, yes, this is a real competitor to Bellator, PFL, UFC, all of that, and they're just getting their footing and they'll get there, you might be willing to throw some money in. But if you look at some of these financial numbers, you've got to be willing to really have a high risk appetite right now, because they're still losing money year over year and it's really just growing. Now, the revenue did increase quite a bit. It jumped all the way up from 37 million Singaporean dollars or so to 62 million. So that's not quite double, but it's a big jump, which is great. But when your costs and your net operating cash flow drop that much, so that you still end up really, upping your losses by $40 million, that's going to be hard for investors to look at and say, ooh, I really want to, put my money in. So, there's a lot of things to consider here. So I'm going to go ahead and give you my final verdict on whether or not I think One Championship will go bankrupt, at least in the short term. Before I do, make sure you hit that like button. Make sure you hit the subscribe if you haven't done that already. Hit the notification button so you know when we're dropping the newest videos. If you like this stuff, if you don't, let us know in the comments. Let us know what we can improve. We're here to serve you. We want to cover this type of stuff with you. So with that being said, I think in the short term, these guys are okay. They're acting like they've gotten a new round of investment. There's been nothing officially announced, but they're really kind of ramping up a couple of certain marketing tactics that would make me think in the short term they've got their money set away and they've got enough liquidity that they won't get in trouble in terms of, needing to pay off debts within a year, not being able to do it, and then having to declare bankruptcy. The fact that they're such a low debt company in general does extend their runway much more than usual, because that is something that could attract a potential investor, right? If you see a highly debt leveraged company coming and knocking on your door and they've got to pay a ridiculous amount of money by the end of the year, that's probably too much risk for most investors, at least, the type of investors that are willing to throw, several $1 million into a particular venture, tens of millions of dollars in some cases. But when your debt is so low, even if you're operating at a loss, you can eventually turn it around, right? There are a lot of startups that do this. There are a lot of startups that really are built on this type of thing. We've seen startups like Uber, like Tesla. Like Tesla is a perfect example, where operated at a loss for a long time and then turned profitable. Uber isn't there yet, but a lot of these, startups, that's kind of their thing, is we're going to be losing money, but we're going to be spending money to build marketing, to build our audience, to build revenue, which they are showing a big boost in revenue. And if they're able to sell the investors saying, you know what, we nearly doubled our revenue this year, we think we can keep the costs about what they are now and double it again, and then they start trending in the right direction, that might be worth it. Doubling your revenue or getting close to doubling your revenue like that is important. It is a big sign saying, yes, we didn't just ramp up the cost and we don't have anything to show for it. So you may be able to, as a company in that position, get some investors to hop on board. You might not. But either way, I think they've got enough runway here that they're okay. 2020 is probably going to be an even worse year for them in some regards because of the coronavirus. But I think that investors may be willing to overlook that as well, because they did cancel events, from April, I think, till July is when they came back, around then. So that's going to be a big factor. But that also should cut down on costs, right? They weren't spending as much on marketing during that time period. They weren't out, really promoting their events as much as they do, which marketing is one of their biggest expenses. So I think it will be okay in that regard. I don't expect to look at their 2020 financial statements when that's filed at this point, maybe 2022, 2023, and see, oh man, like they are now at 0.2 on their current ratio, or in a negative current ratio. They can't pay their first year, or they can't pay their debts within a year. I don't expect to see that. And as long as you can pay your debts within a year, you're generally okay on the runway front. They'll still need to attract investors. But again, I'm seeing signs that make me think that's probably true. And they've already, gotten some investors in there. So I think that they're going to be okay, at least short term. Long term, they've got to do something. If 2020 and 2021 keep showing, a loss just greater and greater, I think at that point they're not going to be able to go to the well and attract money coming in from big hedge funds or private equity groups that are willing to fund this type of thing, because these costs are huge, right? You can't go to a small bank and say, hey, give me a loan for this, or your buddies and say, hey, everybody pitch in. I mean, $100 million loss nearly in 2019. That is not very good. So they've really got to pivot here. These next 2 years are going to be crucial, especially seeing what 2020 and 2021 post-pandemic looks like. If they're not able to turn the corner there, we could be looking at the end of one championship here, not too far out. So if you like this video, make sure you check out the Fight Business podcast. I'm going to break that down even further, go into some more of the detailed aspects of one championship, give a little bit more nuance to some of the numbers, and talk about what Chatri can do to kind of pivot the business, and check out our other content. But thanks for watching, and we'll catch you later.